Welcome to our presentation on the U.S. banking system, the quick and easy version, part 2, brought to you by rebelcapitalist.com. Don't worry, this is not a college lecture or a high school lesson. We do hope that you learn at least one thing from this presentation. Okay, let's quickly run through what we're going to cover in part 2. First, deposit insurance, the linchpin, at least in my opinion, the linchpin of our financial system. Next, we're going to look at how banks make money. We're going to explore the trouble that banks get in very briefly. And I'm going to conclude by putting a plug in for credit unions. The Federal Deposit Insurance Corporation is an independent governmental agency that insures certain customer deposits, and I have to stress certain. Now, I can't stress enough the importance of the FDIC. The FDIC, in my opinion, is the linchpin in our financial system. Banks have to be members of the FDIC. Most banks are members. And one way to determine if a bank is a member is simply by walking through the doors of a bank and checking to see if they have a sticker on the door, an FDIC sticker, or ask someone who works at the bank, or go to FDIC.gov to find out. What is insured? Well, you have checking accounts, savings accounts, trust accounts, certificates of deposit, and certain IRA accounts. What is not insured? Non-deposit investment products such as mutual funds, annuities, life insurance policies, stocks, and bonds. What are the insurance limits? And this is very important. Generally, each account is insured up to $100,000 per depositor per bank, and certain IRA accounts up to $250,000 per owner per bank. I cannot stress enough the $100,000 per depositor. This is very important. I stressed in the previous slide the importance of the limits that are based on a depositor, not on each account. Here's an example. We have Marcy Jones. Marcy Jones owns a NOW account, a savings, a CD, and she has checking for her business. Her total deposits are $150,000. Now the amount of the insurance, since it is per depositor, it's $100,000. So that means that she still has $50,000 of account balances that are uninsured. Let's look at the case of joint accounts. A co-owner's share of each account that is jointly held at the same bank is added together with the co-owner's other share of accounts, and that total is insured up to $100,000. Now let's look at the example. You have Mary, John, and Robert Smith. Mary and John have a NOW account and a savings account together. Mary, John, and Robert own a CD together, so the total deposits are $275,000. Now let's look at the insurance coverage. This is where it gets very interesting. Mary and John have the same ownership share of deposits, which is $112,500. But they are only insured up to $100,000. So that means that $12,500 is left uninsured for Mary and John. Now for Robert, his 1/3 interest in the CD, at $50,000, is fully insured. So what's the moral of the story here? Well, if you have more than $100,000 in deposits at one bank, be careful. And congratulations. If you do have that amount of money saved up, that's great. But you may want to consider spreading the wealth to other banks because diversification is key even in this context. So how do banks make money? Well, on a very basic level, banks make loans, and their loans are considered assets. Banks also issue deposits, such as our savings, checking, and CD accounts. These deposits are liabilities to them. Again, very basic. Banks will take deposits and make loans with the deposited money. The banks make the money on the difference between the interest earned on the loan and the interest owed on the deposit. Here's an example. So you have on the left side, you have banks taking in deposits, savings deposits, checking, certificates of deposit. And then on the right side, you have the money going out in the form of loans, mortgage loans, auto loans, business loans. And let's say the average interest rate on the loan is 6%. And the average interest rate on a deposit account is 3%, which, oh, that's pretty good. So the average profit, I mean, just on a very basic level, the average profit for the bank is the difference, which is around 3%. So again, I mean, this is just very general terms, just trying to give you a sense of how they make money. And this has actually changed over time, as we'll see here. Banks have diversified their money-making opportunities. They make money, a lot of money, on service fees, such as ATM. There's certain fees for checking accounts. Some banks charge people who actually use tellers. And the other big money-making opportunity for banks now are issuing credit cards. The trouble for banks begins when the bank's assets or the loans that they own become either non-performing or troubled, meaning the bank's borrowers are beginning to default on loans or foreclosures are increasing. Now keep in mind, the banks still owe depositors interest on their deposits, their deposit accounts, but the bank is losing interest income from its loans. The worst case scenario is that the loans that the bank owns, their assets, are worth less than the bank deposits, which are their liabilities. In this case, the bank is essentially insolvent. Okay, here's my plug for credit unions. Credit unions are an excellent alternative to the impersonal big money center banks, and we strongly encourage people to examine the banking services that credit unions provide. You will be pleasantly surprised. Now, credit unions are owned by their members. They're not owned by shareholders who are hot after a profit. And you will not see a president of a credit union getting some big executive compensation plan. And they're not just at work anymore. In the past, credit unions were organized around places of employment, such as a teacher's credit union. But today, federal law allows credit unions to organize around geographic locations, such as neighborhoods, cities, and counties. So this means that credit unions are more accessible to people than they were 20 years ago. Why credit unions? Well, credit unions are less likely to charge various fees. You have some banks who charge these hidden fees and various service fees for checking accounts or ATMs or using a teller. Credit unions are not-for-profit cooperatives. They are in it to serve their members. They're not in it to make money. It is strictly to serve the banking needs of their members. And their rates are competitive and possibly, in many cases, better than banks. Now, if you're interested in finding out more about credit unions or trying to locate a credit union near you, we strongly encourage you to go to the Credit Union National Association's website, which is www.cuna.org. That concludes our presentation on Part 2 of the U.S. banking system. We hope to see you at rebelcapitalist.com. Good day and good luck.